Hey everyone, excited to be back with you today. I hope your week's going well and summer's in full swing for you. Excited to spend the time and talk a little bit about some investments and investment strategy. Today we're going to be talking about investing in stocks, bonds, mutual funds, and ETFs, and talking about what the differences between each of these different accounts are and how you can best set up an investment strategy for yourself and really what they even mean to begin with as you look at building your own portfolio. Let's dive in and get started. All right. So talking about these different funds and investment strategy, why does this matter for you and for court reporters? Number one, you probably want to retire, right? And if you do want to retire, you're going to need to start building some investments and setting up your investment accounts. And it's helpful just to know what we're even working with, whether you wanted to do your planning on your own or you wanted to work with a financial advisor. Regardless, you're going to want to know some of the basics of investment strategy. And so knowing these stocks, bonds, mutual funds, and ETFs and what these mean, it'll just help you either manage your own portfolio or have a good understanding of what your financial advisor is doing for you. So you're not just blindly trusting them with your financial plan, but you really have a good baseline understanding of the investments that they're putting in place for you. Also, as you look at building your accounts and planning for retirement, these could be accounts that you're drawing from as well in retirement. So it's helpful to know what investment strategies are better for working years versus retirement years, and what are some of the pros and cons and how you can use those as income streams for yourself in retirement. I know a lot of people say, hey, I want passive income. I want to have like real estate or some type of portfolio that's paying me each month. And I think oftentimes people don't think of their investments as being passive income, right? Being able to pull money from your investment accounts every year to fund your retirement plan, it is passive income. It doesn't have to be real estate or have someone paying you and be like business income. It really can just be from pulling from your investment accounts over time. So the investment menu, right? As we look at the different accounts that you can invest in and set up, each one has a different purpose and strategy, like how you have maybe your laptop for planning for your business and scheduling, and then you have your stenograph for when you're in depositions and actually, doing your job. And then you have different tools, your seat, your stand, right? There's all these different pieces to your job and what you're using. And the same thing goes with your investments and what you have set up. So we want to look at these different pieces and make sure that we're being as strategic as possible with them. Number one, and I'm trying to just pull up here on my phone, the live chat so that I can see if there's any questions as we come in. So let me pull that up real quick. But as I'm pulling up, the first thing I want to go through today is going to be on the stocks. So what are stocks? The easiest way to think about stocks is it's owning a piece of your company. If you own like your own company and you're investing, let's say you're set up as an S-corp right now. S-corps, you earn your salary as your W-2 income, and then you have your owner distributions, your K-1 distributions, and that's like paying the profits out to you. The same thing is owning a stock. You're owning part of the company. So number one, if the company has profits at the end of the year, they get to pay those profits out to you, just like your S-corp is doing the same thing in the form of those owners distributions. So you can pay out the profits and you receive those, and those are going to be called dividends that you receive. So you're getting dividends from the company doing well and having profit at the end of the year. The other part of owning company stock is that if the company's performing well, people will believe that the company is going to continue to perform well and do better and better, and the overall value of the company is going to keep going up. So what this does is it causes people to want to buy more stock and buy more ownership in the company. And the more people that buy ownership in the company, the higher that price is going to go up. So you're going to see the actual price of the shares that you bought go up as well. So there's really two ways that you can get a benefit or a profit from your investments. It's dividends paid out by the company, and it's the actual stock price going up in value, and then you selling it at that higher price later on and collecting that profit as well. So you're actually part owner of the company. Now, the downside of being part owner of a company is that the company could do poorly and that stock can drop really fast. It could be dropping slowly, and then all of a sudden they announce a bankruptcy, and your stock could be worth absolutely nothing at that point, and that's worthless, right? You just lost all that money that you put into the company. So buying one company is extremely risky because we don't know how that company is going to do over time, and there's going to be a lot more fluctuation in your portfolio. But because you're taking some of this risk, there is definitely a higher growth potential compared to some of the other strategies that are out there. So next is going to be the flip side of that, which is going to be owning bonds. So if you own a bond, you could own a bond for a company as well. So let's say we were talking about like Apple and owning Apple stock, you own part of the company, right? We just talked about that. But now let's talk about bonds. You can have an Apple bond. And so what that means is that you're acting as the bank and you're actually just lending Apple money to use for their business. So you as the bank, you get to charge them an interest rate on this loan for borrowing this money. And so you're getting paid out that interest rate throughout the life of the bond. And then at the end of the bond period, maybe it's 1 year, 2 years, 10 years, right? Whatever it is, you get your money back that you put in. So you're just lending them money, you're getting paid interest, and then you get your money back at the end of the road. So one of the ways that you make money off of your bond is the interest that you earn. So that's the profit that you're getting. And that could be like an income source, right? So people own bonds in retirement and they are leaving their principal amount of money, but then they're taking the interest every year. And that's their passive income that they're getting for their lifestyle. So that's one way that you could bring in money from your bond and make a profit. The other way is if the profit changes, or sorry, the interest rate changes in your bond. So let's say, for example, your bond is paying a 5% interest rate. Let's say, sorry, that your bond's paying a 5% interest rate. And then we have new bonds that are being issued by Apple that are now only paying a 4% interest rate. Now your bond is worth more because it's paying 5. And if someone wants to go buy a brand new one, they can only get it for 4. So that actually makes the price of your bond more valuable, which means you could sell it for more than what you paid for it, right? So you could have lent Apple $1,000 and that's what you're hoping to get your 5% on, but then you could sell your bond to someone else for maybe $1,200 because they're going to get a higher interest rate than they could if they go buy a brand new one. So you could also sell bonds for different price ranges like you can for stocks as well. The thing with the bond, though, is they're generally a lot safer. When we think about adding safety to our portfolio, we think about adding a bond. And the main reason that we do that is because you are just getting an interest rate, right? So if Apple stops selling as many iPhones and their price in their stocks go down because they think the company's not worth as much, that doesn't really affect you on the bond side as much because you're just still getting the interest from Apple being paid out to you, right? There's no price fluctuation as far as like how well the business is doing. So it's much more stable. Also, if a company does go bankrupt, the first people that get paid out are the bondholders. So in a situation of bankruptcy, you're much more likely to get your money back as a bondholder than you would be as a stockholder. So switching over now to mutual funds and ETFs, what I want you to think about is think about the S&P 500, right? That's something that we always see in the news every day. It's always being tracked. When people say, this is how the market's doing, right? The market's doing really good this year. The market's doing really bad this year. They're talking about usually the S&P 500 or the Dow Jones, one of those. But we'll focus on the S&P 500 for this example. So the S&P 500 is the 500 largest companies in the US. So it doesn't matter anything about those companies, but if you're one of the top 500, then you're included in that S&P 500. So when we think about buying a mutual fund, what a mutual fund is, you could buy a mutual fund that's, say, an S&P 500 mutual fund. And you're going to pay for a manager to manage this mutual fund. And what the manager is doing is they're looking at these 500 companies and saying, okay, of these 500 companies, who's doing really well and is going to continue crushing it and their stock price is going to go up? And who are the companies in this 500 that they've been doing really good, but 10 years from now, I don't see them being profitable. They probably won't be around at that point. So the job of a mutual fund manager is to pick, maybe they're picking 200 or 300 of the 500 different companies, and they're single-handedly looking for the ones that they know are going to be profitable and hopefully filtering out all the losers. So because of that, there's much higher fees with a mutual fund than with an ETF, because you have to pay the salary of the mutual fund managers who are helping filter this down. You got to pay for their investment research, right? There's a lot of costs that are associated with this. And so there's much higher fees associated as well. Moving on from the mutual funds to the ETFs, is, if we go back to this S&P 500 example, instead of paying for a manager to try and filter down to 200 or 300 of the 500 different options, an ETF, it just buys all 500, right? So there is no strategy where you need a mutual fund manager. All you need is the software that's keeping track of this. Because if the company's in the top 500, you own it as part of your portfolio. If it's not in the top 500, then you don't own it, right? So it's very straightforward, just buying all 500 and spreading out that risk, compared to investing in a mutual fund where you're paying for managers to filter it down. So it's like a mutual fund because you can have either a S&P 500 ETF, or you could have an S&P 500 mutual fund, right? They both exist. They're two different ways to go about investing. They both usually track indexes as well. So like I mentioned, the S&P 500, you could also have an international ETF that just invests in all international stocks. They even have total market ETFs where you're buying the entire stock market. And so again, there's no strategy there. You just own all of the different stocks available, and you're really spreading out your risk at that point. But the fees are significantly lower. And the fees here, the difference, a mutual fund could be anywhere from 0.8% or maybe even 0.5%, all the way up to 3% fee per year for a mutual fund. An ETF, we usually see the fees for an ETF is around like 0.1% or 0.08%, 0.06%. So it's going to be significantly lower than what you have in the mutual fund, because again, there are no managers that you're paying to manage this portfolio for you. So a quick comparison here to look at the differences. First and foremost, stocks and bonds, right? Stocks are more risky, bonds are more safe. So when you're building a portfolio, if you want to add safety to your portfolio, you're probably going to be adding more bonds. If you don't want to have as much safety, you have a long timeline, you want to be more aggressive, then you can do something like a stock portfolio. That's going to be much higher risk. On the return side, historically, stocks do around 8 to 12% return, where bonds do around 3 to 5%. So again, you're going to have a higher rate of return with a stock, but you have much more risk and fluctuation in the portfolio. Fees for both of these are pretty low because you're just buying a stock or a bond. You're not paying for any managers or software, anything like that. So it's pretty straightforward. Maybe you just have to pay like a $20 investment trade fee or something like that. But most of the companies these days don't charge any type of trade fee. And then again, if you want growth in your portfolio, you want stocks. If you want income and safety, you want bonds. So that's how we're looking at that. And then if we want to own a lot of stocks or a lot of bonds in one portfolio, which is typically what we look at doing for our clients, then we would invest broadly in multiple stocks. So you can buy mutual funds or ETFs that own hundreds or thousands of stocks at once. So if one goes bankrupt, you're really not hurting that bad because you have so many in your portfolio. So then we can filter down the mutual funds or ETFs, which one we want to go. Typically, they're pretty similar as far as level of risk. If you're thinking about the same area of the market that you're buying, the returns could be fairly similar. Historically, we have seen that ETFs do better than mutual funds 80% of the time. So ETFs are definitely the more popular route these days. Some of the ways that mutual funds can do better is there's mutual funds that focus on like tax sensitivity as well. So those are always options where it makes more sense to buy a mutual fund. Fees are higher for mutual funds versus ETFs. And then which route you want to go. If you want a hands-off approach, then you probably want to go a mutual fund because it's going to be diversified and you have managers doing the work for you. But if you want to be a little bit more active in your management and have a bit more balance, you can buy ETFs and have multiple ETFs, right? You could have 5, 6, 7 ETFs. And then your job is really what percentage do I weigh into each of these ETFs? So it's filtering it down a little bit. So for a court reporter specifically, which one makes sense? Well, typically starting out, people like ETFs for the simplicity. They like the low minimums, the low cost. So ETFs are usually pretty popular. Also, as well, by investing in stock ETFs, you're going to have a bit more of an aggressive portfolio. And if you have 20, 30, 40, 50 years left until you're planning to retire or slow down your work schedule, then you probably could go a little bit more aggressive in your investment strategy, because if the market goes down, you're going to have time to recover and you're going to get the highest rate of return possible. As you continue growing in your career and building wealth, you're probably going to want to back down your aggressiveness a little bit, starting to mix both bonds and stocks in your portfolio and back down some of that risk as your timeline gets shorter and shorter. And then really as you're approaching retirement, then we're going to want even more bonds and more stability. You've done all the hard work growing and building your accounts over time. Now we want to make sure that we don't lose all the money that you earned up until this point and start to bring in that income that you can live off of in retirement. As far as like just a quick tip that I had here in the bottom for any of those in the variable income space, usually our freelancers that we're working with, dollar cost averaging is a great strategy to implement with your investments. And what dollar cost averaging is that you don't try and pick a good day or a bad day to invest your money. You periodically do it every single month systematically. And so you're taking out that risk of the market being really high right when you dump all your money in and then crashing. Or it would be a good alternative, but you add money to the market and it goes up right away, right? That would be best case scenario. But we know that's not always going to happen. And we want to protect against the opposite, where you dump a bunch of money in the market and then the market tanks right after that. So if we can spread out that risk by doing a systematic amount each month into your investment strategy, and we don't change it based on what's going on in the market, we'll have a lower average cost that you paid for your stocks over time. And it's just a much more strategic and efficient way to invest than trying to pick in time when we want to dump money in. Some of the mistakes that you may want to try to avoid and that I see from court reporters, number one is keeping everything in savings, right? Not investing at all. We want to make sure that we're getting some growth potential. I know people like savings accounts right now because they are earning 4 or 5% because interest rates are so high, which is really good. But if you look at what you would have done if you put money into a savings account starting from before COVID until now, you would still be down compared to inflation. So interest rates are high because inflation is high, right? We try to slow down inflation. We make it really hard to go spend money because buying a home, buying a car is going to cost you a lot more because of higher interest rates. So they're trying to slow everything down. And that's why we have these high interest rates and forced you to save money instead of spending it, right? And putting it into this savings account. But inflation has been so much higher than what you could earn in your savings account for the last few years that we need to keep investing it just to even keep pace with inflation at a minimum, but really to make sure that your investments are growing and you're going to have those assets for retirement. Also, trying to pick individual stocks without research is definitely a no-no. There's so many different places on social media, newsletters, websites that you can learn about different stocks real quick and get little quick stock tips. The reality is, if the person referring or recommending this stock doesn't do poorly, they're just not going to talk about it. If they recommend a stock that takes off over the next 6 months, they're going to be talking all about how they knew exactly what to do and what to invest in your portfolio. So we just want to stay away from any individual stock picks without a lot of research. And even with a lot of research, it's still just extremely aggressive. We typically recommend that you don't own more than 5% of your overall portfolio in one company. So if you want to own one company, 5% of your portfolio should be the absolute maximum. Next is panicking during market drops. So especially during April this year, right, the market tanked with all the news of the tariffs. And then we see now that it's completely rebounded and we're back up 10% year to date, right? So we want to make sure that we don't sell when the market's down. If you're investing correctly, you're only taking as much risk as you're willing to based on the timeline that you have left. If you have under a year to spend this money, you're not going to invest aggressively. You're going to play it safe. And so you don't really have to worry about that dropping 20% and having to sell at a loss. So not only we want to make sure you don't panic sell, but having a strategy that aligns with your timeline will make sure that the money's there when you need it and not put you in a bad situation. And then lastly, is not starting because it seems too complicated. I know we're going over a lot today, but staying involved in this group and learning from these webinars will hopefully help you with your investments and your financial planning. But you can definitely start easy and start with just a couple ETFs in your portfolio and then get a little bit more advanced as you go along. But the last thing you want to do again is just leave everything sitting in cash. You're not going to get any tax deductions for your income. You're not going to be growing money for retirement, and you're going to be actually losing money to inflation. So the last thing we want to do is just leave everything because it just seems like too much to handle. So as far as action steps that you can take today, number one would be opening a brokerage account, a retirement account if you haven't done it, some type of investment account that you can start growing your money. Number two would be looking at, even like I said, one or two ETFs. You can buy like even a total stock market ETF where you're just buying literally the entire stock market. So the risk of one or two companies doing poorly is not going to affect your portfolio. Again, this isn't a specific recommendation. Definitely speak with a financial advisor or professional about this before you make any decisions here. But just from an educational standpoint, this is a route that you could go. Step three would be setting up those automatic monthly investments. So like I mentioned, doing that dollar cost averaging where you're consistently adding money to the market is going to be the most efficient approach. And then number four is when you do have good months in the market, you do a little bit more on top of that systematic savings. So maybe you're doing $1,000 a month no matter what, but then you have a really great month. You can throw in another 2,000 or 3,000 on top of that and take advantage of these good months to get more money in the market. So it's a combination with court reporters because your income's going to fluctuate, but you know a general minimum amount that you're going to make. Hey, I can at least do $1,000 a month to this plan, but then when I do have these good months, here's some extra amount that I'm going to be willing to throw in. So it's a balance with court reporters as far as that fluctuating income, but that would be the best approach to go. So just to wrap up today, I didn't see any questions come in during this live webinar, but if you do have any questions, feel free to leave them in the comments and I'll be happy to get those answered. You can also DM me privately if you're watching this on Facebook, and I can get your question answered as well. Again, we talked about specific investments and stocks and bonds. Everything I talked about today is really just for educational purposes, but not any specific recommendation for you to implement. So make sure that you're consulting with a professional if you want to get this stuff set up. If you do want to reach out and set up a meeting with me, we can do a complimentary financial strategy session, look at your investment strategy right now and see if there's anything that we would do differently in order to make sure you're being as efficient and strategic as possible. So if you do want to get that set up, feel free to contact me with the contact info I have below, or you can go to traction-wealth.com/talk and book a meeting there as well. So let me know if you guys have any questions in the comments. But other than that, I'll see you next week and see you again soon.